What's up, everyone? It's Eric with Option Edge, and today we're looking at Amazon, okay? Just a little recap of what has been going on with Amazon. So they had earnings on, that was July 29th. They had some earnings, and for the first time in a while, they actually missed their earnings and didn't have quite as good of earnings as Wall Street thought. And from there, the stock took a nosedive, okay? And it's been on a pretty big downtrend in the last basically the whole month. Okay, so finally, as you can see here, we dropped below the 200-day moving average. Okay, and that's the 200-day moving average is for a lot of these algorithm trading bots. That's like a strong signal to it's a weakness, a signal of weakness, not just for the algorithms that the bots that the algo traders that trade stocks and options, but just in general, it is considered a very weak signal. And some may argue whether it matters with these moving averages or not. But the thing that matters is it's because other people believe they matter. It's sort of a self-fulfilling prophecy. So since other people think they matter, when this happens, people think the stock is weak. Other people believe it, and it sort of reinforces this. It's like a self-fulfilling prophecy. Anyway, so we went down below that, and since then took a couple days to then cross up. Okay, and you can see yesterday on the 23rd, Monday, we touched, but then we went back down. But today we saw a strong push through and close above that 200-day moving average. Okay, so let's look at historically what type of option strategy that would work. So I'm looking at a put spread, okay, where we sell a 40 delta put and buy a 30 delta put, okay? So the technicals for this is let's look here. Technical open. Cross up through the 200-day moving average. The stock has to be above the 10-day moving average, and the RSI has to be below below 70, okay? So the idea is crossing up through the 200-day moving average is a signal of strength. The 10-day exponential moving average is like a momentum signal. Okay, so and then the the RSI is we're making sure that the stock isn't overbought. Which, if you're below the 200-day moving average, more often than not, you should always probably be below below a 70 reading of RSI. So I'm just going to look at, this is just little pivot points here. So let's check the RSI. RSI is 43. Okay, so we're below 70. 200-day moving average, we crossed up through that, but let's check out the 10-day, and you can see that we are above the 10-day, or we crossed up the 10-day. Actually, let's just verify. Let's go to indicators. Let's go to EMA, exponential moving average. The default is set to 9. Let's set that to 10. And okay, it looks like yesterday, I'm not sure. We might have closed right above it or just slightly below, but it doesn't matter. We're above it today. So historically, we've seen some good returns. Okay, average win percentage was almost 27%. Blah blah blah. So, all right, let's look at on the option chain, which strikes and the date. So 30 days from today is September 24th, and we're looking at selling the 3,265 put, and then buying behind that the 3,210 put. Okay, so that's if you have a large account, you can do that. So your max loss is going to be about $3,200. So if you're like me and you don't want to risk $3,000 on one trade, this is what I did. I selected the right here. This is what I did. I did the 4140 delta. We're selling that one and buying the 38, 39, 37 delta behind that. Okay, so it's only 10 strikes. It's 10 strikes wide. So let's take a look at that. So we're going to cancel that one. We're selling this one, and let's buy this one. Okay, so here our max win is the credit. which is $380. Okay, remind me later. And the max loss is the credit minus the width of the strikes. Width of the strikes is 10, so that's 1,000. 1,000 minus the credit, 380. It's going to equal $620. So the max loss is $620. Max win is the total credit received. Okay, so it's basically we're risking 2 to make 1. Okay, but so risking 2 to make 1, and but historically the back test shows some good results. Okay, good results. Average win, boom. Average loss, boom. Okay. So, and we can, this is with a, this is with, do we have any, so this is with a 50% gain. Let's type, I like to do 50, 100. Let's see how that comes out. 100% stop loss, 50% gain, we're out. All right, that's not as good. So if you got some cojones, try and hold on to this trade for the long run. Okay, let's try 150. And remember, this is just historical backtesting. Just because it happened in the past does not mean it's going to happen in the future. All right, 150 loss. So yeah, us losing 150 percent of what we put in. So we're putting in 380 times 1.5 is going to be a $570 loss. Yes, because 380 divided by 2 is 190. 190 plus 380 is 570. Okay, so we're risking, if we stick with these parameters, the 50% limit, we're out, and the 150% stop limit, we're out. Max loss is 570, and we come a little bit closer to risking 1 to make 1, but not quite. Okay, risking 1.5 to make 1. All right, so let's just something else I want to talk about is besides just this, I want to look at the weighting, okay, in the S&P 500, okay? So if you look, here's the top 10 holdings that make up 27% of the assets in the S&P 500. So if you look, Amazon is pretty heavily weighted behind Apple and Microsoft, okay? So it's a 4% weighting. So that means it's pretty correlated with the S&P 500. So if we come here, if we look, S&P 500, so as you can see, the S&P 500 hit the top of its Bollinger Band, and historically, when it hits the top of its Bollinger Band, you're going to see here, comes close to the Bollinger Band, we roll over. Comes close to the Bollinger Band, we roll over. Same thing here, we get close to the Bollinger Band, roll over. Here, it sort of continued, but then eventually rolled over. Boom here. So you get the idea. So one thing I'm a little bit worried about is, we could see some downward action. So what in addition to selling this put spread, I bought a little, I bought a calendar spread in the S&P 500. But that's, I won't go into the details of that. It's something I like to do when the S&P 500 hits the top of its Bollinger Band. But that's it. That's we call this trade fading the dip. We're not buying the dip. We're fading it because as long as Amazon stays above that 200-day moving average, or basically above the put we're selling, which is about this right here, then we are going to profit. Okay. Hope you guys enjoyed this. Happy trading. As always, this is not trading advice, just for educational purposes. And like and subscribe if you're liking this content. Thank you guys. Peace out.